Capital budgeting is the process businesses use for decision-making on capital projects, those projects with a life of a year or more. Imagine you're building a house. You wouldn't start without a blueprint, right? Similarly, companies need a plan for long-term investments, like buying equipment or launching new products. This careful planning is called capital budgeting.
Effective capital budgeting is crucial for a company's financial health and growth. By evaluating potential investments, companies can allocate resources wisely. This ensures that funds are directed towards profitable endeavors that align with their overall strategic goals. Just like a solid foundation is essential for a sturdy house, sound capital budgeting practices are the bedrock of successful businesses.
The payback period is a simple capital budgeting technique that answers the question, how long will it take to recover the initial investment? This method is particularly useful for small businesses and individual investors who need a quick and easy way to evaluate the viability of their investments. It measures the time required for an investment's cumulative cash inflows to equal the initial cash outlay. By calculating this period, investors can determine how long their money will be tied up before they start seeing returns. Imagine investing in a lemonade stand that costs $100 to set up. This simple example helps illustrate the concept in a tangible way. If you earn $25 per day selling lemonade, the payback period would be 4 days. This means that in just 4 days, you would have recovered your initial investment, and any earnings beyond that point would be profit. The shorter the payback period, the more attractive the investment. Investors often prefer investments with shorter payback periods because they can recover their money faster and reinvest it in other opportunities. This is because the initial outlay is recouped faster, reducing the risk of prolonged exposure to uncertainty. In volatile markets, a quick return on investment can be crucial for maintaining financial stability. However, the payback period has its limitations. It doesn't account for the profitability of an investment beyond the payback period, which can be a significant drawback for long-term projects. It doesn't consider the time value of money or cash flows beyond the payback period. This means that it ignores the potential benefits of future cash inflows, which can be substantial in some cases.
This is a straightforward way to gauge an investment, but as mentioned, it has its drawbacks. Investors should be aware of these limitations and consider other methods for a more comprehensive analysis. Let's dive deeper into a more refined approach. By combining the payback period with other financial metrics, investors can gain a more complete understanding of an investment's potential and make more informed decisions.
The discounted payback period addresses a key limitation of the simple payback period by considering the time value of money. This concept is crucial for making informed financial decisions, as it takes into account the changing value of money over time. It recognizes that a dollar received today is worth more than a dollar received in the future. This principle is fundamental in finance and investing, as it helps in evaluating the true value of future cash flows. This is because money today can be invested to earn a return. The potential to grow your money through investments makes the present value of money higher than its future value. Imagine receiving $100 today versus receiving $100 in a year. The difference in value becomes evident when you consider the investment opportunities available today. If you invest the $100 today at a 5% interest rate, you'll have $105 in a year. This example illustrates how the time value of money works in practice.
The discounted payback period calculates the time it takes to recover the initial investment using discounted cash flows. This method provides a more realistic assessment of an investment's profitability. Discounted cash flows are adjusted to reflect their present value, considering the time value of money. This adjustment ensures that future cash flows are accurately represented in today's terms. This adjustment provides a more accurate measure of an investment's profitability than the simple payback period. By incorporating the time value of money, investors can make better decisions and achieve more reliable financial outcomes.
The net present value, NPV, is a widely used capital budgeting technique that calculates the present value of an investment's future cash flows. This method is essential for businesses to evaluate the profitability of potential projects and investments. It then subtracts the initial investment outlay to determine the net value added by the project. This subtraction helps in understanding whether the project will generate more value than it costs. Think of it as weighing the benefits, future cash flows, against the costs, initial investment. This balance is crucial for making sound financial decisions. If the NPV is positive, the investment is considered profitable because the present value of its future cash flows exceeds the initial cost. This positive outcome indicates that the project is expected to generate more wealth for the company. Conversely, a negative NPV indicates that the investment is expected to result in a net loss. This negative result serves as a warning sign that the project may not be worth pursuing. Generally, projects with higher NPVs are preferred as they create more value for the company. Companies often prioritize these projects to maximize their returns and ensure long-term growth.
NPV is often considered the gold standard in capital budgeting, providing a comprehensive view of an investment's potential profitability. It offers a clear picture of the expected financial benefits and helps in comparing different investment opportunities. By focusing on the present value of future cash flows, it helps companies make informed, strategic investment decisions. This focus ensures that businesses allocate their resources efficiently and choose projects that will enhance their financial health and competitive position in the market. Section 5 Internal Rate of Return, or IRR, measuring investment efficiency.
The internal rate of return, or IRR, is the discount rate that makes the net present value, or NPV, of an investment equal to zero.
In simpler terms, it's the rate of return an investment is expected to generate.
Think of it as the investment's break-even point.
If the IRR is higher than the company's required rate of return, the investment is considered acceptable.
The IRR provides a measure of an investment's profitability, expressed as a percentage.
It helps compare different investment opportunities and select those that are expected to yield the highest returns. Section 6, Profitability Index (PI), ranking projects by value creation.
The Profitability Index, or PI, is a capital budgeting tool that measures the value created per unit of investment.
It's calculated by dividing the present value of an investment's future cash flows by the initial investment outlay.
Imagine investing $100 in a project that generates $150 in present value cash flows.
The PI would be 1.5 because 150 divided by 100 equals 1.5.
A PI greater than 1 indicates that the project is profitable.
It means that for every dollar invested, the project is expected to generate more than $1 in return.
The PI is particularly useful for ranking and comparing multiple investment opportunities, especially when there are budget constraints.
Section 7. Mitigating forecasting risks, sensitivity analysis and scenario planning.
Forecasting future cash flows is crucial in capital budgeting, but it's inherently uncertain.
To address this, companies use techniques like sensitivity analysis and scenario planning.
Imagine trying to predict the sales of a new ice cream flavor.
Factors like weather, competition, and consumer preferences can all impact sales.
Sensitivity analysis examines how changes in key variables, such as sales volume or raw material prices, affect the project's NPV or IRR.
It helps identify the variables that have the most significant impact on profitability.
Scenario planning involves creating different scenarios, like optimistic, pessimistic, and most likely, and assessing the project's performance under each scenario.
Section 8. Real-world applications illustrating the power of capital budgeting.
Let's look at some real-world examples of how companies use capital budgeting techniques.
A manufacturing company might use NPV analysis to decide whether to invest in new equipment that increases production efficiency.
A pharmaceutical company might employ IRR to evaluate the potential return on investment for developing a new drug.
Retail chains like Walmart use capital budgeting to determine the financial viability of opening new stores, considering factors like location, competition, and potential revenue.
Tech companies like Apple rely on these techniques to assess the profitability of developing new products like the iPhone or investing in research and development for future technologies.
Section 9. Conclusion: making sound investment decisions with confidence.
Capital budgeting is an indispensable tool for financial management, enabling companies to make informed decisions about long-term investments and allocate resources wisely.
By utilizing techniques like NPV, IRR, and PI, companies can assess the profitability and risks associated with potential projects.
Mastering these techniques equips businesses with the tools necessary to navigate the complexities of capital allocation.
By carefully evaluating investment opportunities, considering the time value of money, and mitigating forecasting risks, companies can make sound decisions that drive growth, enhance profitability, and create long-term value for stakeholders.